Hey, Tom, it's good to see you. We are diving into the headlines today about Silicon Valley Bank and the markets. And we are talking about this on a Tuesday, still a lot of moving parts, but I know you wanted to make sure you were communicating with clients about the Fed working right now to stem a US banking crisis. So let's start with what's most important to your clients. What do they need to know?
I think the most important thing to know at this stage is that you're not at risk. Uh,
Hmm.
Through Brookstone Capital, our broker dealer, we house our clients' accounts individually. They're custodianed at TD Ameritrade. Your accounts are your accounts. Your holdings are your holdings. They're not commingled with anybody. They're not coexisting with anybody else's. Your stuff is your stuff. I think that's the most important thing to start with.
Right.
Secondly, the portfolios that we work with and the assets that we typically or have been recommending to folks don't include specifically, as far as I know, the Silicon Valley Bank. So in that sense, we don't have any exposure or risk in the client portfolio. So that's one thing. What's going on, I don't think is a systemic problem. Maybe it's a symbolic problem of government overreach or government interference and poor bank management. But I don't. Although we're going to see some volatility in the markets, we're going to see some volatility in the bank stocks. May actually see another couple of banks need to get taken over by the FDIC. But overall, big picture, I don't see this as a major meltdown like we saw in 2008.
Okay. What if I just as, my regular bank down the street, what if I have more than $250,000 in the bank? Because that is the max amount that the FDIC will insure. Should I be thinking more about that?
Well, I would think about it, and if it's possible to make changes, have a couple of different bank accounts at a couple of different banks and stay under the 250, that would be preferable. The Fed did announce, or I'm sorry, FDIC did announce yesterday that they are even in this case they're even going to cover the uninsured deposits of clients at these banks that they have taken over. So I don't know if that's going to be something going forward for any deposit in any bank that the FDIC comes in or the regulators come in and take over, or if it's just going to be for those two, Signature Bank and for Silicon Valley Bank. We don't know at this stage. So my advice is play it safe, stay under the 250.
Which is always good advice, no matter what's going on in the headlines. So I think a lot of people want to know too, how does this compare to the 2008 financial and banking crisis?
Right now, it seems to be that the banks that are most exposed are the smaller regional banks. So it's not the bigger, larger institutions like the JP Morgans and the Citibanks and the Goldman Sachs that it was last time. So in a sense, it's a little bit more contained, and it may not be as big of a problem, but of course, it's going to be a problem. I would expect that there probably will be some other institutions that need some help along the way, but I don't think it's going to be as big, drastic, and nasty as it was in 2008. But we have to be prepared for some volatility and for some problems until they get this stuff figured out.
Right. I know you always plan for volatility. It's good just to hear that again. So
Right.
besides that, is there anything else that you're watching for next?
Well, we're just watching for economic signs of what's going on. So we just, again, we want to see what the Treasury, the government reaction is. We want to see if any other institutions are going to be needing help. We're going to need to see how badly the American taxpayer is going to get hit with this, because they are, despite maybe what we're hearing on the news, it's the taxpayers who end up paying in the end. So we're watching for that. Consumer debt, how much is that playing into any of the problems that the banks are having? Interest rate fluctuations, because that was one of the biggest problems that led up to the Silicon Valley Bank issues, is that they actually had to sell U.S. Treasuries at a discounted value to keep their capitalization intact, and that hurt. That hurt a lot, and the main cause of the FDIC coming in and taking them over.
Yeah, I think it's going to come down to mismanagement too. So,
For sure, it was.
Tom, I really appreciate being able to talk this through with you. If somebody does have questions though about, something that they're hearing or reading, or if they're just feeling anxious, what's the best way to reach you?
Well, everybody knows they can just give me a call at 973-394-0623 or email me, tjoconnell@internationalfinancial.com. I get back to you as quickly as I can, especially with concerns and questions and issues about what's going on. I know how important it is to have boots on the ground, so to speak, and have as much updated information as quickly as possible.
Right. Which is why I appreciate you making time on such a busy day too. Tom,
Well,
thank you very much.
Thanks.
Thank you.